Wall Street is reacting strongly ahead of tomorrow's crucial CPI report. The S&P 500 and Nasdaq are climbing, driven by a surge in chip stocks and easing crude oil prices. Here's an in-depth look at today's market movements and their implications. Looking ahead, tomorrow's Consumer Price Index (CPI) report will serve as a crucial catalyst for market movement. This report, which measures inflation by tracking the price changes of a basket of goods and services, is closely watched by economists and investors alike. A softer inflation reading would likely bolster expectations for interest rate cuts by the Federal Reserve, potentially providing an additional boost to technology and semiconductor stocks. These sectors, known for their high valuations, have been particularly sensitive to interest rate fluctuations, as lower rates typically enhance their growth prospects. Conversely, if the report reveals higher than expected inflation, it could exert significant pressure on stocks across the board, especially in high valuation segments like growth and semiconductors. The backdrop of this report is critical. Over the past year, inflation has fluctuated, prompting the Federal Reserve to adopt a cautious approach to monetary policy. Many analysts believe that sustained inflation could force the Fed to maintain or even increase interest rates, which would dampen consumer spending and investment. Market analysts are closely monitoring these developments, emphasizing the importance of the CPI figures as they reflect broader economic health. Investors should prepare for potential volatility in the coming days as market reactions unfold based on the CPI outcomes. The impact of this report goes beyond immediate stock movements. A clear direction in inflation trends will influence corporate earnings, consumer behavior, and overall economic growth. As businesses adjust their strategies in response to changing economic conditions, the fundamental landscape of the market may shift dramatically. As we anticipate the CPI release, all eyes will be on the figures, with a keen focus on how they will shape the future trajectory of the stock market and the economy at large. The backdrop to today's market rally began with a slight rebound on Monday, signaling resilience among investors after a tumultuous period. Today's gains indicate that dip buyers remain active, particularly in the technology and semiconductor sectors, which have been pivotal in driving market momentum. The rally in chip stocks has been reinforced by company-specific momentum as several technology firms reported better-than-expected earnings, showcasing their ability to adapt and innovate. Additionally, there is a widespread belief in the ongoing strength of AI-related spending as a significant earnings driver for tech companies, reflecting broader trends in digital transformation. Lower oil prices have also alleviated immediate inflation concerns, further encouraging market activity and boosting investor confidence. The historical context is critical. The market has experienced significant volatility over the past year, largely driven by persistent inflation fears and rising interest rates. These factors have created an environment of uncertainty, prompting investors to be cautious in their approach. However, the recent dip-buying trends suggest that many see current valuations as attractive, especially in sectors poised for growth. As investors await the upcoming Consumer Price Index report, which is expected to provide further insights into inflation trends, the current sentiment reflects cautious optimism shaped by previous data and economic indicators. The impact of this rally could be significant, as a sustained uptick in technology stocks may encourage broader market participation, potentially leading to a more robust recovery. If inflation continues to moderate and economic growth remains steady, we could see a shift in investor sentiment, favoring riskier assets. Looking ahead, the market's ability to maintain this momentum will largely depend on upcoming economic data, particularly inflation readings and corporate earnings, which will be pivotal in shaping investment strategies. Today's market movements are significant for several reasons, particularly as investors await the upcoming Consumer Price Index (CPI) report. This report is critical because it provides insights into inflation trends, which directly influence Federal Reserve policy decisions. A shift in the Fed's approach can lead to a rapid repricing of bonds, growth stocks, and the entire equity market. This is especially true for semiconductor stocks, which have shown heightened sensitivity to interest rate changes. A favorable inflation reading could extend the current rally in tech stocks, propelling companies that rely heavily on consumer spending and innovation. Conversely, a hotter inflation print may reverse this momentum, leading to a sell-off in tech and growth sectors. The context surrounding this situation is rooted in a turbulent economic landscape. Inflation has remained a pivotal concern for both policymakers and consumers. The Federal Reserve has been navigating a delicate balance between controlling inflation and fostering economic growth. Recent interest rate hikes aimed at curbing inflation have led to increased borrowing costs, impacting everything from mortgages to corporate financing. As a result, the market's reaction to the CPI report is not just a matter of numbers. It reflects broader economic sentiments. Investors are currently signaling a readiness to take on more risk ahead of the data, indicating a degree of optimism. However, the prevailing uncertainty creates a precarious environment, with many holding their breath as they await the results. The implications of these market movements extend beyond traders and institutional investors. The average person should care because fluctuations in stock prices can significantly affect retirement accounts, consumer confidence, and overall economic stability. For many, the performance of the stock market is directly tied to their financial well-being. A positive CPI report could bolster market conditions, further encouraging spending and investment. On the other hand, disappointing data might trigger broader market sell-offs, impacting multiple sectors and individuals alike, resulting in a ripple effect throughout the economy. Looking ahead, the upcoming CPI report will serve as a crucial barometer for market sentiment and economic health. Investors and consumers alike will be closely monitoring the results, as they will likely set the tone for market dynamics in the coming weeks. On June 10, 2026, Wall Street experienced a notable pre-CPI risk-on move. The S&P 500 rose by 0.30%, while the Nasdaq Composite climbed 0.86% in early trading, with the Dow slightly lower. The standout performers were semiconductor stocks, with Micron, SanDisk, and Marvell all posting strong gains. This upward momentum comes as investors position themselves ahead of the upcoming Consumer Price Index report, which is set to be a major macro test for both interest rates and equities. The CPI, a key measure of inflation, will provide critical insights into the Federal Reserve's monetary policy direction, particularly as inflationary pressures have been a concern in recent months. Today's market rally was also supported by lower crude oil prices, which eased inflationary pressures, boosting investor sentiment. Lower oil prices typically indicate reduced costs for consumers and businesses, translating to increased spending power and economic activity. The recent decline in crude oil has sparked optimism among investors, who view it as a sign that inflation may be stabilizing. The market's movement reflects a willingness to take on risk ahead of critical data, indicating that investors are actively buying into positions while remaining cautiously optimistic. This behavior is characteristic of a market that is trying to balance the potential for economic growth against the backdrop of persistent inflation concerns. The tech sector, particularly semiconductor stocks, has shown resilience, driven by strong demand for chips in various industries, including automotive and consumer electronics. As we look ahead, the implications of the upcoming CPI report cannot be overstated. Should the report indicate that inflation is cooling, we could see sustained market gains and a more favorable environment for risk assets. Conversely, any unexpected spike in inflation could lead to increased volatility and a reassessment of interest rate projections. Investors will be closely monitoring economic indicators in the coming weeks, including employment data and consumer spending trends. The outcome of these reports will be crucial in shaping market sentiment and guiding investment strategies as we enter the second half of the year. Ultimately, the path forward will hinge on the interplay between inflation data and economic growth signals. As the market braces for tomorrow's CPI report, how will the results influence stock prices? Share your predictions in the comments, and don't forget to subscribe for daily deep dives into the latest financial news.